Can you take loans from an insurance policy or loans from against an insurance policy and never pay them back? You can, but if you do it early on, you might run into something called tax on phantom income. When you take a loan from a policy, you're actually taking a loan typically from an insurance company. Well, a guy buys a policy at age 33. At age 33, buys a policy, puts money in there. It's a $450,000 policy. The fund value grows to $30,000. He takes a loan against it for $10,000. Now, that loan comes out tax-free because it comes from the insurance company, and it's under what's called the adjusted cost basis. The cash value is $20,000 because it's the net of these two, 30 minus 10. If we fast forward 7 years to today, that 10% loan grows to $17,000, and the $30,000 cash value grows to $41,000, leaving a difference in cash value of $24,000. So a little bit of growth, but compound interest, Rule 72, all the stuff we teach about that gets people excited works against loans too. So one of the things we look at is at age 78, the loan is going to compound at 10%, but the investments are currently compounding at 5%. And when these things meet, what's going to happen is the policy is likely going to lapse. If a policy lapses, CRA says we're going to give you tax-free income, but later if you lapse the policy, it's considered a disposition and they're going to tax the fund value as income. Now the fund value is the total amount as if you had, for example, a rental home and a mortgage. You get taxed on the value of the rental home regardless of your mortgage. And so here, if this has debt to be paid and a fund value, the net amount the client will get back at age 78 is zero. And the tax they'll receive is they'll receive a taxable income of an extra $98,000 on top of whatever income they have. Now, I think CRA can be ruthless. I think they can give you tax-free early on, but we got to make sure if you're going to build stuff like this, you got to look at your cost of insurance, that I would like it to be level or paid up. I don't really like personally increasing cost of insurance and increasing loans. Eventually that's a recipe for lapsing. And then you also want to look at your interest rate on your loan and your performance on your investments. We would like our investments to perform more than our loan to make sure they don't get caught. And I think a lot of times people don't want a review of their policy, but if you have a policy that you plan on taking loans from, or you took a very small loan when you were young, the loan is tax-free, but the interest over time will accrue and it will compound so that it puts you in a position where the loan compounds and you'll pay tax on the interest of a tax-free loan later in your life. And so there's some details about this that are very straightforward, except it's not really publicly talked about how this works, what this looks like. And so just remember, many times when you get a benefit, you also have to give something up. And so when something seems, hey, I'll just take a tax-free loan now, I won't pay it back, I'll let it compound. And then later on, if you lapse the policy or don't keep it, then it could hurt you. So if you have one of these, or you are talking about, people are talking about doing an IRP and retiring early and don't worry about the future, or they don't talk about the risks of some of this stuff, that the fund value is in the market. The financial industry or your relationship with your advisor is very similar to your relationship with your doctor. If you got a great advisor and you're a great client, so very well for you. But if you're an unhealthy client or patient and you got a doctor that's kind of crummy, someone who understands this stuff intimately, can explain it clearly, reach out to me to order an in-force illustration and show you what your numbers look like, that the financial industry is very predictable. And so we want to make sure that we do all the surprising up front. Reach out, please, and let me know your question and we'll get it answered.